Thank you so much, Marlene and Standard Bank, for that opening address. Let's get started with our first presentation of the day. I would like to welcome Tamir Khan, Head of Research, Middle East Africa, JLL, who's going to present on investment and capital flows over the past 24 months.
Hi, good morning, everyone. Very excited to be here, and thank you for having me. I'm Timur Khan. I'm the head of research across Middle East and Africa for JLL. And over the course of this morning, next 10 or 15 minutes, we'll be going through what's happening in global investment markets and also within regional investment markets as well. But before we go on to the capital market story, we want to look at the global sentiment that real estate is really facing at the moment. We do this survey every quarter. We ask about 2,000 people a pretty simple question. Over the 6 months, do you think market conditions will either improve, stay the same, or worsen? And we had a pretty good run in 2024, generally after a couple of years where interest rates are going up and the fallout from COVID. With 24, we're seeing overall the lion's share actually seeing the improve. Of course, this year in the first quarter, we had the Liberation Day, the tariff tantrum, as some may call it. And we saw that decrease pretty substantially, but the bounce back in August has been pretty evident, I think, when we've seen what's happened across various regions. And when you move across to different areas, the Americas, EMEA, and Asia Pacific, what we're finding actually is the largest majority of respondents are seeing that real estate is improving. And I think if you ask this question today after rates went down yesterday, that number will increase slightly. Moving on to the capital market side, some of the key trends that we'll delve into today. The pace of transaction growth. We've seen this moderate, particularly in Q2. Largely, a lot of investors sort of held back after the various different issues that we had with tariffs, but particularly in the industrial and logistics sector, and particularly in the Americas. So we saw about 14% year-on-year growth, but it's down from around 31% year-on-year growth the quarter before. We'll delve into the details of this. We're seeing that asset prices are actually remaining relatively firm. We seem to have reached that base across the board, not even sort of, even in certain secondary asset classes as well. And where we did have some repricing because of Liberation Day, that most of that is cleaned up now. Debt markets are incredibly resilient. We've seen those individuals who are sitting on the sidelines, and particularly sort of larger deals, coming back to the forefront currently. More and more, we're moving away from the thematic side of investing. Not only is it automatically going into multifamily, into industrial logistics, but actually the fundamentals are more and more important going forward. So, interestingly enough, offices has really come up, and we'll look at the details of this, and as is retail as well. And despite all of the issues and despite some of the challenges we're seeing on a geographic basis, we've seen very little evidence that actually cross-border investments are changing geographically as well. Starting off with the divergence of interest rates. It's been incredible. Very rarely have we seen interest rates move so far apart, particularly with the US and the ECB and even the RBA. And this has caused some challenges in certain markets, and it's caused challenges when it comes to activity. Alongside this, obviously, we've seen quite a lot of changes within tax structures across different parts of the world, and that has impacted investor sentiment. But, like I said, from yesterday onwards, and I think generally we are seeing that pricing is now a lot more stable, and we're starting to see deals happen as there's a bit more clarity on the forward funds rate going forward. When you're looking at debt origination, this has changed quite substantially. In terms of the growth rate within debt origination, we're seeing this growth rate outpace direct investment flows at the moment, which is quite positive for general real estate and the investment climate. And we've seen that those guys, particularly the single asset, single buyer facilitators, the CMBS, they're actually coming online now as well. As are those sort of $100 million plus development funders. Now we're seeing that being actively funded now as well. And we've seen around $49 billion raised in the last quarter. If you look at the last couple of years in terms of a quarterly figure, that's way above where we've been more recently. But we have seen a moderation in transactions. So like I said, we went from 31% growth year on year on a global level to about 14% growth year on year. But generally, we have seen this sort of pick up. I mean, we're on target with a 21% growth half year this year compared to half year last year, that we expect those numbers to actually be higher than where we were previously. And if you look at the last couple of months, it seems that the uncertainty is sort of waning away as we speak currently. From a regional perspective, America's up 22%, EMEA 22%, and APAC 17%. APAC started off a bit earlier in its bull run and now is moderating in terms of growth. But there's some real outperformance locations, despite the fact there's quite significant challenges and with quite an international audience here. If you look at the US particularly, up 20%, UK as well, also up 15% as well. So actually, there's quite a lot of investment going into these markets, although they do face some baseline challenges. Sector-level allocations, I think this is quite interesting. If you look at this chart, you might not see so many changes, but like I said, the fundamentals are changing pretty rapidly within the market at the moment. We are seeing somewhat of a sort of takeoff from the industrial and logistics side, offices coming back into it, but multifamily remaining quite a strong sort of asset class. But when you look at it from H1 this year compared to from 2022, we see that actually offices, increasing by 31%, quite a substantial increase there. But also retail seeing quite strong growth rates at 22% in terms of investment volumes. Like I said, now today, individuals and buyers are focusing on the fundamentals rather than purely looking at the thematics from an investment point of view. From a geographical perspective, like I said, we've seen, following Liberation Day, that actually cross-border investments are still up 21%. There's still quite considerable interest. We saw a decline and a pause, particularly from the Australian and the Australian super funds, the Canadian pension funds, actually putting on hold investments, particularly into industrial and logistics real estate across the market. They've resumed since then, and generally we've seen cross-border capital continue to increase. And if you look at it from a perspective of which regions it's going into, the US still remains about 48% of total recipients in terms of cross-border. So very, very significant from that perspective. If you look at the interest rate market within Africa, our general house view is that rates have peaked and actually will start to decline over the coming period. And we think that will also then continue to then drive yield compression in certain segments of the market, start to drive development and generally activity, really based on two things: rental growth coming into the market and also new development and new grade of product coming on. I think there's going to be quite a lot of fragmentation between the top end of the market, good quality, high-end, well-covenant stock compared to B-grade stock. And that's a trend that we're seeing in all different parts of the world. From a currency fluctuation perspective, I think Marlene mentioned the stability that we are starting to see, and that's coming out in the forecast at the moment. If you look at this chart here, 2024 is sort of the basis, and then we see how much certain currencies have been devalued. And that's difficult if you're an international investor. That's difficult if you're a local investor as well, to sort of from a returns perspective. And more we're seeing that funds are looking to have operating income generating funds as well. And that, in terms of when looking to entice international investors, will be pretty critical going forward. But one other thing that we really need, and particularly this age, this day, in terms of technology, the data, which is becoming, and has always been really, quite critical, is the fact that we need transparency within the market. Africa has quite a lot of representatives within the low transparency, even the opaque side of JLL's Global Transparency Index. And it's important because 84% of global direct investments go into those 13 countries on the left-hand side. We're seeing that the gap is actually shifting. Even though certain markets within the region are improving, we're seeing that the top end of the market, even sort of those transparent countries, they're improving very, very rapidly. And that 84% could actually go up if this is not improved. So this is pretty critical. And if you look at it, we've mapped this out historically. We've been doing this since 1999. And we've mapped it out to see exactly how much of a difference it makes to actually investment volumes. Now, without that transparency, you just will not get to sort of that top left-hand corner. And this is probably one of the most critical bits that now we have stronger fundamentals coming in, is actually allowing to have the data, the information, the funds to be able to then entice those international investors to come in. Because frankly, the fundamentals, the population, which my colleague Wayne will talk about a bit later, are incredibly attractive, but the track record needs to be there as well. So thank you very much for your time, and I appreciate your attention. I'll hand back over and go from there.